understanding your risk using beta weighted delta. Beta weighted delta is a little known but very important metric that help you to manage your risk. Let's take an example of TLT, which is the bonds, and SPY, the stocks. Usually bonds and stocks move in opposite direction. So most of the time when TLT goes up, SPY goes down. Investors are moving money out of the fixed income bonds and putting in high risk stocks because they feel stocks have a better return potential. When they see any risk, they generally start selling the stocks, and putting the money in bonds. So TLT and SPY have a negative correlation. Similarly, in periods of turmoil, gold goes up and stocks go down. And during good times, when stock market goes up and people feel good, discretionary stocks do really well. As an example, Netflix and SPY have a positive correlation, which means when SPY goes up, stock market goes up, usually Netflix also does very well. So that helps us to understand what will I lose or gain if a stock market, let's say, crashes or if it goes up. Because some stocks go up when stock market goes up, and some stocks go down when stock market goes up. So beta weighted delta is a simple calculation based on how each symbol correlates with the index. If you have 10 different symbols, you are not sure what will happen if a market suddenly crashes tomorrow. Are you going to lose a lot of money, little money, or gain money? Or if the stock goes up, stock market goes up a lot, are you going to win or lose? Beta weighted delta is a simple number that helps you to understand that. Here is an example. Basically, I was talking about correlation. So SPY is the stock market index. It has a correlation of 1:1 because it is the metric against which we are comparing. But look at TLT. TLT has a negative correlation of 26. So when the stock market goes up, TLT goes down. But now look at Netflix. Netflix has a correlation of 92. So if you carry Netflix and SPY, you're going to do very well when the market is going up and going to be punished when the stock market is going down. Similarly, if you have carried TLT, which is the bonds, and gold, you're going to be punished like now where the stock market has been steadily going up. And this brings us to the important concept that is wrongly taught in many financial channels. EEM. EEM is International Fund. So even when I was taking my Series 65 test, in the question related to diversification, it was mentioning that one of the ways to diversify is to invest in international markets. But look at this. When SPY is 1 and EEM is 83, basically they are correlated almost 1:1. So if SPY is doing well, EEM is likely to do well. And if SPY is going to do bad, then EEM is also going to crash. How do we beta weight? In Thinkorswim, you have an option called beta weighting. You can beta weight against anything, but it is generally not any good idea unless you have it as SPY. So you beta weight against it, and all your portfolio gets, like, each one has its own delta, which means in Disney I am long 11 delta, in gold I am long 2.5 delta and so on. But if you look at what is my beta weighting, it is 62.79. That equals to my positions are equivalent to owning about 62.79 stocks of SPY. It's as simple as that. They convert all the risk into a single unit of measurement called as beta weighted delta. One good thing about this beta weighted delta is that it is not specific to stocks or options. So you can just be owning stocks, or you could be owning stocks and you might be buying options, or you might be selling options, even futures. All of those things have some sorts of correlation with the indexes, and the beta weighted delta takes care of that. You can uncheck the beta weighted delta and get an individual position. So for example, here Disney is 18 delta and gold is 67 delta, which is really long without beta weighted. But when I beta weight, it's only 2.45. So this gives me a perfect understanding, or at least close understanding, as to what is my risk. Once we know the risk, we can plan our trades accordingly. As an example, if you have a positive beta weighted delta, you're likely to make money when the stocks are going up. If you have a negative beta weighted delta, you're likely to make money when the stocks are going down. Just to let you know, not all platforms do have beta weighted delta. It's only few platforms like Thinkorswim and Tastyworks have beta weighted delta. So how do I make trading decisions based on beta weighted delta? Let's say if you have too much of negative delta in your portfolio, that means you are going to make money when the stock market is going to go down. You can try to close out some of the short positions or add some long position to neutralize your positions, or basically try to get delta to close to zero. You do not want to add more short positions. Yes, you will make quite a good money when the market is going down, but what happens if the market starts going up? You will lose a lot of money. The next scenario, if you have too much positive delta in your portfolio, that means you're going to make good money when the market is going to go up. But what happens if it starts going down tomorrow? Try to close out some long positions or add some short position to neutralize the positions, which means try to get the delta close to zero. Do not add more long positions because already you are positive delta. So if market keeps going down, you will lose a lot of money. In my scenario right now, 62.75, so I am long. So just by going by this beta weighted delta, since I am long, I do not want to add more longs into it, even though there will be plenty of opportunities that might get presented to me. I would look for opportunities on the short side to make sure my delta reduces close to zero. I always insist to my friends that if a broker does not have beta weighted delta, it's time to move out. It is that important. So until the next video, happy and safe trading, my friends.